Hello everyone, welcome back to our channel. In this second part of our two-part video series, we continue our exploration of 40 income tax deduction available for the year 2023. If you haven't watched part 1 yet, be sure to check it out for the first 20 deductions. In part 2, we will cover the remaining 20 deductions, providing valuable insights into how they can benefit you and your tax planning. By understanding these deductions, you can make informed financial decisions and potentially save on taxes. So let's get started. Section 80CCC of the Income Tax Act offers taxpayers deduction on contribution made to pension funds for the purpose of securing retirement income. These contributions are aimed at promoting long-term financial planning. Under Section 80CCC, individuals can claim deductions for contribution made to pension funds offered by LIC or any other insurer. This deduction is applicable to those who contribute to these funds to secure their retirement income. The maximum deduction allowed under Section 80CCC for contribution to pension funds is Rs 1.5 lakh per financial year. However, it's important to review the specific terms and conditions of the pension fund with eligibility criteria and the deduction limit. Section 80CCD of the Income Tax Act offers taxpayer deduction on contribution made to pension scheme such as the National Pension Scheme and the Atal Pension Scheme. These contributions are aimed at promoting retirement planning and ensuring a secure future. Under Section 80CCD, individuals can claim deductions for contributions made to pension schemes like NPS and the Atal Pension Scheme. This deduction is applicable to those who contribute to these schemes to secure their retirement income. The maximum deduction allowed under Section 80CCD for contributions to pension scheme is Rs 1.5 lakh per year. Section 80CCD1 encompasses contribution made by government employees, private employees and self-employed individuals toward their retirement funds. This provision encourages everyone to plan their financial security during their golden years. All the citizens aged between 18 to 60 years can take advantage of Section 80CCD1. Whether you are just starting your career or nearing retirement, this section provides a window of opportunity to secure your future financially. Contribution limits for government employees and private employees can contribute up to 10% of their basic salary and dearness allowance DA or 10% of their gross income, while self-employed individuals can contribute up to 20% of their gross income. The maximum deduction for self-employed individuals is 1.5 lakh. Section 80CCD 1B is a game changer. It offers an extra Rs 50,000 deduction for those who have already claimed the maximum Rs 1.5 lakh under Section 80C. This means you can save more taxes while securing your financial future. All these fantastic benefits applies to all government employees, private employees and self-employed individuals. No matter your employment status, you can take advantage of this provision to optimize your tax planning. Thus, the maximum limit of exemption is Rs 2 lakh under Section 80CCD1 plus Section 80CCD1B. Section 80CCD2 empowers salaried individuals with added benefits from their employer's contribution to the NPS. Employers can contribute to NPS in addition to the contribution made towards PPF and EPF, offering an excellent opportunity for retirement planning. Under Section 80CCD2, the employer's contribution can be equal to or higher than the employee's contribution. For employees of the central or state government, the deduction can be up to 14% of their salary, basic plus DA. For those working with any other employer, the maximum deduction is 10% of their salary, basic plus DA. Section 80CCF encourages taxpayers to invest in long-term infrastructure bonds issued by eligible institutions. These bonds play a vital role in financing significant infrastructure projects in the country. Only Indian resident, individuals, HUF, joint investor with 2 or more persons can claim this deduction. Note, in case of joint investor, tax benefit can avail by only one person. The maximum deductions on investment made up to Rs 20,000 in long-term infrastructure bonds. By doing so, they can reduce their taxable income and enjoy valuable tax benefits. Section 80D allows taxpayers to claim deductions on medical insurance premium paid for themselves, their families, and dependent parents. It's a win-win situation ensuring both health and tax benefits. The deduction limit for Section 80D is as follows: Rs 25,000 for premiums paid for self and family, and Rs 50,000 for premiums paid for senior citizen parents. In addition to insurance premiums, Section 80D also covers health checkups up to Rs 5,000 within the overall limit. Prioritizing preventive care can lead to early detection of health issues. Section 80DD allows resident individuals and HUFs to claim fixed deduction for supporting and maintaining their dependent who is differentially able. The deduction is irrespective of the actual expenditure incurred and serves as a crucial lifeline for the dependent's well-being. The amount of deduction under Section 80DD depends on the severity of the disability. The deduction limit is 75,000 where the disability is more than 40% and less than 80%. Where the disability is more than 80%, the deduction amount is Rs 1.25 lakh. To claim deductions under Section 80DD, taxpayers need to submit relevant medical certificates and documents supporting the disability condition of their dependents. Section 80DDB allows taxpayers to claim deductions on medical expenses incurred for the treatment of specified diseases. This provision recognizes the financial burden faced by individuals undergoing critical medical treatments. Section 80DDB covers a range of specified diseases, including severe ailments like cancer, neurological disorders, chronic renal failure, and more. Taxpayers can seek deductions for medical expenses related to these illnesses. The deduction limit under Section 80DDB vary based on the age of the patient. For individuals below 60 years, you can claim up to Rs 40,000, and for senior citizens 60 years or above, you can claim up to Rs 1 lakh. Section 80E enables taxpayers to claim deduction on interest paid on higher education loans taken from financial institutions. There is no limit on the maximum amount of deduction, providing significant financial relief to students and their families. The deduction is available for a maximum period of 8 years, allowing individuals to pursue higher education without undue financial burden. To claim the deduction, taxpayers need to obtain a certificate from their bank, segregating the principal and interest portion of the education loan paid during the financial year. Only the total interest paid will be allowed as a deduction with no tax benefit on the principal repayment. Section 80EE of the Income Tax Act, which offers valuable additional deductions on home loan interest for first-time homeowners. It allows eligible homeowners to claim an extra deduction of Rs 50,000 on the interest components of their home loan EMIs. This deduction is in addition to the regular interest deduction available under Section 24. To avail the additional deduction under Section 80EE, the following condition must be met. The home loan must not exceed Rs 35 lakh. The value of the property must not exceed 50 lakh. The individual must not own any other property registered under their name at the time of the loan is sanctioned. This section is for those who are not eligible to claim under Section 80EE. Section 80EA provides a higher deduction up to Rs 1.5 lakh on interest payable for loans taken to purchase residential properties. This section aims to increase home ownership opportunities for more individuals. Section 80 EEB promotes sustainability by offering a deduction up to Rs 1.5 lakh on the purchase of electric vehicles. Encouraging eco-friendly choices, this provision supports environmental conservation efforts. Section 80G allows taxpayers to save tax by donating money to eligible charitable institutions and organizations. The donation made can qualify for deductions ranging from 50% to 100% of the amount donated. The deduction range for Section 80G donations varies based on the nature of the institution. First, donation to certain approved funds, trusts and charitable institutions for social cause may qualify for 50% deduction. Contribution to specific causes such as the PM CARES Fund or Prime Minister's National Relief Fund may be eligible for 100% deduction. Section 80GG is a special provision applicable to the individuals residing in a rented property who do not receive HRA from their employers as a part of their monthly compensation. Both salaried and self-employed professionals can claim Section 80GG deductions. This provision extends its benefit to entrepreneurs and business owners as well. The deduction limit under Section 80GG is determined based on Tax Rule 2A and Section 1013A. The least amount from the following calculations become the non-taxable income. First is Rs 5,000 per month or 60,000 annually. Second, the yearly rent amount minus 10% of the taxpayer's adjusted total income. Third, 25% of the adjusted total income for a year. By carefully calculating the three figures for an individual, the least of them becomes the applicable deduction for Section 80GG. This deduction allows taxpayers to optimize their tax planning effectively. Section 80GGA allows taxpayers to claim deduction for donations made towards scientific, social, and statistical research, while cash donations are limited up to Rs 2,000. Other modes of payment can qualify for their deductions. Supporting research and social causes enables individuals to contribute a knowledge and welfare. Indian companies can claim deduction for contribution made towards political parties under Section 80GGB. However, to qualify for deductions, donation must be via check, demand draft or internet banking. Cash donations are not eligible for deduction, promoting transparency in political funding. For contributions made by individuals, excluding local authorities and government-funded entities, Section 80GGC provides deduction for donation to political parties. As with the deduction 80GGB, contribution must be made through non-cash modes, encouraging accountable funding practices. Section 80QQB allows authors to claim deductions on their royalty income from certain specified categories of books. Authors who have pended their creativity into books can benefit from this provision, encouraging their financial well-being. To become eligible for deduction under Section 80QQB, an author's royalty income from the specified category of books must not exceed Rs 3 lakh. Royalty payments are compensation received by individuals for the usage of their creative works. Whether it's a book, art piece, music composition, or invention, the creator is entitled to receive payment from others who utilize their work. To be eligible for deductions under Section 80 RRB, the royalty income from patents should not exceed Rs 3 lakh. Section 80TTA provides deduction to the interest earned from your saving bank account. If you are a saver and earn interest income on your deposits, the provision is designed to support your financial goals. This exemption is available for individuals and HUFs. To become eligible for deductions under Section 80TTA, your savings account interest should not exceed Rs 10,000 per year. The amount is taxable if it exceeds the set criteria. Section 80 TTB is applicable to resident senior citizen aged 60 years and above during any financial year. This provision allows them to claim a specified amount as a deduction from their gross total income. Under Section 80 TTB, senior citizen can claim a deduction of Rs 50,000 or the total income amount, whichever is lower. The deduction is applicable to various sources of income including interest on bank deposits, savings of which, cooperative society deposits and post office deposits. The difference between 80 TTA and 80 TTB is Section 80 TTA enables deduction equivalent to Section 80 TTB. However, it allows interest deduction of up to Rs 10,000 on saving accounts kept in a bank, cooperative bank or post office and only for the taxpayers under the age of 60 or to a HUF. With the introduction of Section 80 TTB is specifically for senior citizens. Deductions under Section TTA are no longer leverable for senior citizens. Section 80U caters to individuals certified as persons with disabilities by medical authorities. To qualify under this section, an individual must have at least 40% disability as certified by the medical authorities. Section 80U allows persons with disabilities to claim a deduction of Rs 75,000 from their gross income. This deduction acknowledges the disability expenses incurred due to the disability. Individuals with severe disabilities faces more significant challenges. For them, Section 80U provides a higher tax deduction of Rs 1.25 lakh from their gross income, offering greater financial relief. Don't get confused between Section 80U and Section 80DD. Section 80U provides tax benefits if an individual suffers a disability, while Section 80DD provides tax benefit if an individual's taxpayer's dependent family member suffers from a disability. This is an additional benefit taxpayers can avail. Section 87A provides a tax rebate to individual taxpayers whose total income. Section 87A provides a tax rebate to individual taxpayers whose total income after deducting applicable deduction under Section 80C to 80U is less than 5 lakh. If your taxable income falls below this threshold, you may claim this rebate. Calculating gross total income to determine eligibility for the rebate. Calculate your gross total income and then subtract deductions claimed under Section 80C to Section 80U. If the resultant taxable income is below Rs 5 lakh, you qualify for the tax rebate. Tax rebate amount for year 2023 to 24. Individuals with taxable income up to Rs 7 lakh will receive a tax relief of Rs 25,000 under Section 87A. This modification is a part of the new tax regime and offers additional tax benefits to eligible taxpayers. This concludes our video on Section 80C for year 2023. As only few days left, make sure you file your ITR before 31st July. If you found this video informative, please give it a thumbs up, share it with your peers, and subscribe to our channel for more income tax related updates. Thank you for watching and we will see you in the next video.